A man loses $20 billion in 2 days. Not over a decade, not through a slow bleed of bad decisions. 2 days. And here's the part that should scare you more than the number. Almost nobody on Wall Street knew his name until the moment he was already gone. He wasn't a bank. He wasn't a hedge fund you'd recognize. He was one guy trading out of an apartment who had been legally banned from the markets less than a decade earlier. By the time he was done, he'd built more market exposure than most global banks carry on their entire balance sheets. And when it collapsed, it took a piece of Credit Suisse down with it, a bank that had survived 2 world wars and the Great Depression. This is the story of Bill Hwang, the trader who got banned, came back bigger, and broke the one rule Wall Street thought it understood best. You can't hide risk forever. Every disaster needs an origin. This one starts with a punishment that didn't stick. Bill Hwang came to America as a child from South Korea. By his 20s, he was already inside one of the most respected hedge funds on the planet, Tiger Management, run by the legendary Julian Robertson. Robertson didn't just hire talent, he built dynasties. The traders who came up under him were nicknamed the Tiger Cubs, and they went on to run some of the biggest funds in the world. Hwang was one of them. In 2001, with Robertson's own money behind him, Hwang launched his own fund, Tiger Asia Management. For a decade, he built a reputation as one of the sharpest Asia-focused stock pickers on Wall Street. Then, in 2012, it fell apart. Hwang got caught insider trading Chinese bank stocks. He and his head trader settled the charges for $44 million combined. He was personally banned from trading in Hong Kong. On paper, this is where the story should end. A disgraced trader, quietly retired, footnote in a financial history book. But Hwang didn't retire. He rebuilt. And the way he rebuilt is the whole reason this story exists. Here's the move. Instead of running a hedge fund, which has to register with regulators and disclose what it owns, Hwang converted his own fortune into something called the family office. A family office manages one person's money. Because it isn't raising outside investor capital, it faces almost none of the disclosure rules a normal hedge fund has to follow. Translation? No public filings. No requirement to tell anyone what stocks he owned, or how much of them. He called it Archegos Capital Management, and he didn't stop there. Archegos didn't buy stock the normal way either. It used something called a total return swap, a contract with a bank where Archegos gets all the gains and losses of a stock's price movement without ever legally owning a single share. The bank buys the real stock to cover its side of the bet. Archegos just puts up a fraction of the money as margin and collects or pays based on where the price moves. No ownership, no disclosure, no name on any public filing anywhere, and massive leverage running on someone else's balance sheet. One quiet structural decision. That's the seed of a $20 billion collapse. Fast forward to March 2020. COVID has emptied Manhattan. Hwang is trading from his apartment, building concentrated bets in a short list of stocks: Viacom CBS, Discovery, Baidu, Tencent Music, VipShop. He isn't spreading his risk across a diversified portfolio. He's stacking enormous, leveraged bets on a handful of names, through swaps, across not one bank, but 8 of them: Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS, Deutsche Bank, Wells Fargo, MUFG. And here's the trap none of them saw. Each bank could only see its own slice of Hwang's book. Credit Suisse had no idea what Morgan Stanley was financing. Goldman had no idea what Nomura was carrying. Everyone was looking at one puzzle piece and calling it the whole picture. By early 2021, Archegos' actual capital sits somewhere around $10 to $20 billion. Its total market exposure, stacked across every bank simultaneously through leverage, over $100 billion. 1 week before it all falls apart, Hwang gathers his staff and talks about growing the fund to $100 billion. He is, at that exact moment, standing on the edge of the largest hidden position in modern Wall Street history. And nobody outside a handful of trading desks even knows he exists. March 24th, 2021. Viacom CBS announces a stock offering. That's it. That's the spark. A routine corporate stock sale. But Viacom CBS is one of Archegos' most concentrated bets, financed through swaps at multiple banks at once. The stock drops 9% that day. By the time the offering prices, it's down roughly 30% from Monday's high. At every bank holding an Archegos swap, the same alarm goes off at once. This collateral just took a huge hit. Time to call for more margin. Hwang doesn't have it. March 25th. Hwang gets on a call with his banks, trying to buy time, asking them to hold off selling, to work out an orderly unwind together instead of a stampede for the exits. Some banks agree to wait. That patience is about to cost them everything. March 26th. This is the day Archegos dies. Goldman Sachs moves first. Before the market even opens, Goldman quietly sells $6.6 billion in Baidu, Tencent Music, and Vipshop shares. Later that day, another $3.9 billion in Viacom CBS, Discovery, and related names. Over $10 billion liquidated in a single session. Fast, clean, first out the door. Morgan Stanley isn't far behind. $4 billion sold in the morning, another $4 billion in the afternoon. Deutsche Bank finds a quieter exit, a private $4 billion block sale to outside buyers, sidestepping the public dumping entirely. And then there's Credit Suisse and Nomura. Still on the phone with Hwang, still trying to be patient, still trying to do this the right way. That hesitation is the single most expensive decision in the entire collapse. By the time they finally sell, the prices are already gone, crushed by everyone who moved faster. A firm that was worth $36 billion at the start of that week is, by the end of a single Friday, worth nothing. Staff are pulled onto a Zoom call. They're told the firm is shutting down. Some of them find out their employer no longer exists before they've even had lunch. Roughly $20 billion in stock forced onto the market in a matter of days. One of the fastest, largest deleveragings in Wall Street history. When the dust settles, the scoreboard tells you everything about how this game actually works. Credit Suisse, roughly $5.5 billion gone, the worst hit by far. Forced to raise nearly $2 billion in emergency capital, slash bonuses, and rip apart its own risk management from the top down. Here's the detail that should make your jaw drop. The year before the collapse, Credit Suisse made just $17.5 million in fees from its entire relationship with Hwang. They took on a multi-billion-dollar tail risk for the profit margin of a mid-sized regional bank branch. Nomura, nearly $3 billion lost. Japan's largest investment bank, shares down a record amount in a single day. Morgan Stanley, $911 million. And they didn't even disclose it right away because it wasn't considered material enough to matter. Goldman Sachs called its own losses immaterial. It moved first, fastest, and hardest, a masterclass in every bank for itself. Deutsche Bank and UBS walked away almost completely clean. Total damage across the banking system, roughly $10 billion. Vaporized in days, because 8 of the smartest financial institutions on Earth were all financing the exact same hidden bet, and none of them thought to ask if anyone else was doing the same thing. For a while, this got filed away as just a spectacular trading blow-up. Reckless leverage, bad luck, an expensive lesson. Then federal prosecutors got involved, and the story changed shape entirely. In 2022, Hwang and his CFO, Patrick Halligan, were charged with 11 and 3 criminal counts respectively: racketeering conspiracy, securities fraud, market manipulation, wire fraud. The government's claim, this wasn't just leverage gone wrong. Hwang had deliberately lied to banks about the size and risk of his positions, using the resulting credit to pump up the very stocks he was betting on. Prosecutors said the portfolio's disclosed value had been inflated from $1.5 billion to $35 billion through manipulation. The trial ran 9 weeks in 2024, and the testimony peeled back exactly how thin the guardrails really were. Bank employees describing billions in credit extended based on little more than trust and reassurance. No independent way to verify how much exposure Hwang actually carried across every other firm at the same time. July 2024, the jury convicts Hwang on 10 of 11 counts. Halligan convicted on all 3. December 2024, Hwang is sentenced to 18 years in federal prison. The man who talked about building a $100 billion empire is now doing decades behind bars. Here's the ending that should actually worry you. The exact loophole that made all of this possible: family offices facing almost no disclosure requirements, swaps letting massive positions hide from public view. None of that has been closed. It's still sitting there in the exact same shape right now. And there's a quieter epilogue most people miss entirely. Credit Suisse never fully recovered from this hit. 2 years later, in 2023, the bank collapsed for good and was swallowed by UBS in an emergency rescue. Archegos wasn't the only reason, but it was one of the first cracks in a wall that eventually came all the way down. So the next time you hear about a quiet family office or a hedge fund manager nobody's ever heard of, remember this: the banking system's biggest blind spots aren't always the villains everyone's already watching. Sometimes they're the ones nobody's looking at, until it's already too late to stop them.